Hi, this is Professor Hazera, and I've just finished grading the Lilly versus Pfizer assignment, and I thought I'd give you just a short 5 or 10 minute recording of some of the things I saw and some things to point out. There's one thing especially, and then what I'm going to do is there's comments that I looked at too, but rather than go through all the comments, I'm going to go ahead and comment in this video on the relative um, ratios of Lilly versus Pfizer. Okay, this is like a contest now. Okay, so first thing I wanted you to be aware of, and I saw, was that a lot of people didn't bother to read the income statement. Oh, by the way, the grades were very good. I would say out of 10 points, the average was 9.2. So if I'm being critical, I'm not being that critical. The answers were overall very good, and a lot of beginners' mistakes. That's why, not a lot of beginners' mistakes, but a lot of this mistake that I'm about to tell you is type of beginner mistake. Whenever you look at financial statements, please start by looking at the top of the income statement, especially. You'll notice that it says right here, shares are in thousands, dollars are in millions. Okay, if you write down, just okay. So, so sorry about that interruption, but I'll finish this. Um, so this is so if the shares are in thousands and dollars are in millions, that means that these dollars here are all in thousands, but these shares down here, or what am I saying? I'm just going to finish this. If this is very informal, I know, but I'm just going to finish this. These dollars are in millions up to there, but these shares down here are in thousands. So if I calculate earnings per share, so let's say I'm calculating earnings per share, and this is the biggest mistake I saw. If you take the net income and divide by the number of shares, you get 0.009 more or less. Now, what you have to do, because they're not in the same unit, and most companies don't do this, be aware Apple does do the same thing, is just multiply this times 1,000, and you will get the answer that matches the earnings per share right there. So I'm going to put those both in red here, and I'll try to upload this sheet. But it's a very common mistake, but be aware that sometimes companies, if they have really high sales like Apple does, they'll put the dollars and millions to cut down the zeros and shares in thousands. Most companies will not do that. They'll have both in the same denominations, but just be aware of that. And that threw a lot of people off. But I didn't count much off for that, maybe a point. And in some cases, if the ratios were perfect except for that, I didn't count anything off. Okay, so let's take a quick look at the ratios here. Okay, the ratios here, and what I've done is it's the same the ratios, it's the same sheet you just did basically, but I sort of just cut and pasted the Pfizer ratios. Okay, so let's take a look at the current ratio. That favors Lilly. Let's take a look at the quick ratio. That favors Lilly. Let's take a look at the account sheet turnover. That favors Pfizer. And let's take a look at inventory turnover. That favors Lilly. So, and most people had this in their comments, and in those comments they said Pfizer, Lilly wins except for accounts receivable turnover. So when it comes to liquidity, Lilly better except for collecting receivables. Okay, so I mean that was and people that was generally the comment that people get, which is good. Okay, times now this over here, we're comparing times interest earned. This once again favors. I'll just put override that. That favors Lilly. I don't think it's a big deal. I think Pfizer probably has some long-term investments that could convert into short-term investments. But this one is huge. PFE. This one favors Pfizer. And it not only favors Pfizer by a little bit. 13. Lilly has a debt-to-equity ratio of 13. So I would say that definitely Lilly has too much debt. Of course, everything's relative here, but the next question would be, you would have to ask yourself, not here, but in some other, as you go on, you're saying, he has too much debt. Why? Why? That would be your next step here. And I don't know if we can cover this in this class. We have classes of financial statement analysis that we do. But why? And are they buying back stock? Investing? That's the big question, is why. So, and the fact that Lilly has a times interest earn ratio of 13.56 is going to affect the return. It's going to inflate return on shareholders' equity. And I made that comment back in some of your answers. Okay, so when it comes to leverage, I don't think it's a question that Pfizer wins. I mean, Lilly just simply has too much debt. Okay, now we get to these ratios down here. Okay, earnings per share. Compare these two, but it means nothing. Obviously, the higher the better. But having high earnings, and some people made this comment, but high EPS do not necessarily imply high expected growth. For that, you have to look at the price-earnings ratio, because all you're doing here, you could be comparing apples and oranges here. What if they both have the same net income, but one has more shares outstanding? I mean, that shows you it's just silly to compare earnings per share. I'll get to what you have to do is come down here and look at the P/E ratio, and that's about the same. So more or less, the growth prospects are the same. Now, where they do differ, I believe, is here, that Pfizer pays more dividends. Pfizer pays more dividends. Pfizer is in one comment I put a dividend monster. Pfizer is a dividend monster. Look at that dividend yield. Great. This is great dividend yield. So be aware of three things here. Number one is that just because you have high earnings per share doesn't mean that you're going to grow. You could be, like I said, two companies could have the same income. One just has more shares outstanding. So that comparison is meaningless. What you have to look at is the PE, and Lilly's a little bit better here, but they're more or less the same. So then you start looking at the dividend, and Pfizer's paying great dividends. So if you're making the comparison, two companies are going to grow about the same rate, but one pays twice the dividends, or as the other one, whatever that is, about 1.5 times the dividends. I would favor Pfizer here because the growth is the same, the dividends are higher. Okay, so I'd say Pfizer wins here. Now we come to return on assets, return on shareholders' equity. Only a couple of people, some people mention the return on assets. Okay, you got return on assets. Lilly is a little more profitable there, so I would say this one goes to Lilly. Lilly wins there. The only other problem with then you come to this and you have Lilly. There's a 100 basis. There's 100 points difference between Lilly's return on assets, return on shareholders' equity, and this is because I think I said this in the videos, but Lilly has a ton of debt. That 13-to-1 debt to equity ratio is what's driving this up. And why does it drive it up? The numerator is more or less the same, but the denominator is, look at the denominator. What's driving it up is the fact that all that debt is driving your shareholders' equity down, which drives that up. So I'm going to say Lilly RSE, return on shareholders' equity, Lilly RSE, inflated by too much. And finally, so that's why it would be nice to look at the gross profit margin, because it's so simple, and their profitability is about the same there. That's the problem with return on assets, return on shareholders' equity. They're measurements, but when you start taking on too much debt, it inflates your return on shareholders' equity. Although from a corporate perspective, really does seem to be better, a little bit more profitable. Overall, I think Pfizer's doing better because of the vaccine and the brand name they're building. Lilly has the monoclonal antibody, but just going back over this, Lilly wins here except for Pfizer, which collects its receivables better. This is the red flag right here. If I could draw a red flag, I would. I'm sure there's a way to do it. This is the red flag right here. All this debt. And so you would have to ask yourself, like I already put there, you would have to ask yourself, why does Lilly have so much debt? And so that would be the next question. This is why you do this. It's not the final thing. These ratios raise red flags. And then make sure that your EPS is divided by 1,000. Several people might have made that mistake. It's a beginner's mistake. Okay, then when it comes to these ratios here, earnings per share, comparing earnings per share doesn't mean anything. Compare the PE ratios, because earnings per share you're comparing apples and oranges basically. It depends on the number of shares. Okay, so the growth is the same, but Pfizer pays a lot more in dividends. So if you have the growth is the same, Pfizer's paying more dividends and has less risk because of less debt, I would start looking at Pfizer more from a basic perspective. And then finally, the Lilly's earnings or return on shareholders' equity is inflated, and gross profit margins are about the same. So overall, I think the theme so far is, number one, Lilly is a little more risky because they have tons of debt. What are they using it for? I think it's stock buybacks. But it's not good to take out debt, too much debt to buy back stock. It's better to take out to buy equipment and fund R&D. And the other thing is Pfizer, they're growing the same, but Pfizer pays that nice dividend, and they've got that vaccine. So Pfizer looks pretty good to me. It looks like a more solid company. Anyway, I'm going to post this video on YouTube and as feedback to what I saw. And I hope it helps. Okay, thank you very much.